Welcome back to the Dad's Wallet Show, Money Fam. This week we have a year-end financial checklist, a stolen car, and how Mark Cuban went from millions to billions. If this is your first time, I'm Dan, your money coach, and I'm here to help your family save money and build lasting wealth. Let's not waste time. Here's your 5-step playbook for financial success for the end of this year. The first item on your year-end financial checklist is going to be to get some perspective. It's time to think big picture on a macro scale. The economy has been really beaten up lately, and rates, inflation, losses, they're going to continue to pile up. Even if it's slowing down through the next year, it's going to hurt. It's time to reduce your inefficiency in your own household and look for long-term opportunities where you can put your money so it'll work harder for you. On this chart that I'm going to share on all of our social media, it's got a lot of great information about how history repeats itself. 82% of the time, there's a positive return 2 years after a recession. And let's not kid ourselves, that's where we are right now. This is why Warren Buffett famously said to be fearful when others are greedy and to be greedy when others are fearful. So if you could go into a casino and place a bet knowing that there's an 82% chance that you would make your money back and then some, that's going to be a great bet. And this is why when people say things are on sale right now, it's not just that the price is lower. The price is lower relative to how high it will be 2 years down the road. And that's just looking at a 2-year time cycle. We're always encouraging you to think big picture and long term. So if you're thinking of investing money now that you're going to need 6 months from now or 12 months from now, then the stock market and some index fund or a mutual fund is not necessarily the best place to put it. But if you're looking for a long-term investment that you want to be able to reliably draw from later on in your life for large milestones or especially for retirement, this is what's going to help build long-lasting wealth with your family. Buy in now and hold for the long term. This is a time to be greedy because there's a lot of fear, a lot of uncertainty, and a lot of volatility in the market. Second item on our year-end financial checklist is tax planning. I know, not super exciting, but tax season really ends at the end of the year, so it's time to sit down, buckle down, get out that pencil, sharpen it up, and think about this. Defer your income if possible and accelerate deductions. Now that's just kind of tax speak for a lot of other things that you may want to be talking about with your tax professional, with your advisor, with your wealth manager. Consider loss harvesting, Roth conversions, capital gains accelerations. Always consider these with some trusted professional, and you can be doing some Googling on your own, but this is a time to really think about investing in yourself and your own plan so that your money's going to work harder for you. It's going to pay off in the long run. This also is a time to adjust your withholding with your employer. So if you maybe had a child in the past year, or you need to adjust your withholding so you don't have a huge tax bill or refund come tax season, this is the time to do it before your income starts rolling for starting in January. Now when we talk about loss harvesting, it generally works like this. You sell an investment that's underperforming and losing money. So you've got a stock out there and it's gone down, the S&P 500 has gone down 17.5% year to date. So then you use that loss to reduce your taxable capital gains and potentially offset up to $3,000 of your ordinary income. So that's a caveat that most people don't really consider. Sometimes people are just looking at loss harvesting as it pertains to your capital gains if you're going to be selling stock that has appreciated versus stock that's depreciated, and you try to offset some of those gains. But you can really see how it impacts your ordinary income too, depending on your income status, level, your different tax implications there. So loss harvesting is definitely something that you should be exploring with your tax pro so that you can maximize on some of the positive and negative sides of your retirement or investment brokered portfolio. Second thing on that list for taxes was a Roth conversion analysis with your advisor. Now, converting at at the end of the year and at a downturn could be a key benefit when you're rolling into a Roth IRA. It may lower your taxes off in the future. Remember, Roth IRAs grow tax-free and then they're not taxed when you take money out. You're putting tax dollars in and you're getting untaxed dollars out in the long run. While there's no upfront tax breaks to a Roth IRA, that growth tax-free could mean a huge benefit for you. And remember that those are increasing next year. So we had a $6,000 max last year. It's going up to $6,500. Really, in my opinion, should be going higher than $6,500. But hey, that's where we're at currently. Maybe you should, get out write an email, write a letter to your senator, your representative to push for Roth IRAs being a catalyst for families, because that's what we're really focused on here. We're focused on families today finding lasting generational changing wealth in the future. And so the next step in your tax planning is going to be looking at your income and seeing if you qualify for a 0% long-term capital gains rate of 0% for 2022. Now, if your taxable income, if you're single, is less than $41,675, or if you're married filing jointly, it's less than $83,350. If it's at that level or under, then you could qualify for a 0% long-term capital gains rate on things that you sell in 2022. So this is another thing that your income and your taxes as they relate to your capital gains have much more in common, or they impact each other at a much greater level than most people think about. So when we talk about capital gains accelerations, then this is something where you want to sit down with your trusted investment advisor and you want to discuss where your income is, where you may think it is in the future, and whether or not it would be beneficial for you to, if you do have some miraculous appreciating asset, to sell it now. Maybe it's something that you've inherited that has been appreciating and you inherited a while ago, so it's not something that you're able to benefit from a recent inheritance, but maybe there's something in your portfolio that's appreciated that this would be a good time for you to go ahead and take that 0% capital gains before your income may increase beyond that threshold. And the last thing on that list is adjusting your withholding. So when you're talking to your employer and you're seeing the overall tax implications of how much you're withholding, how many beneficiaries that you have listed on your form for your employer, then if you're declaring 0, 1, or 2 dependents on your taxes, then it's important to really take a look at how much you're owing the government from your withholding, or probably how much you're getting back. Because if you're getting a big tax refund at tax season in a few months, then that means that you're essentially giving a free loan to the government month over month when they take money out of your paycheck. And I know it's painful, no one enjoys that part, but when you're getting money taken out of your paycheck and then you're letting the government use it and abuse it for 12 months, let's say, then that money could be put to work, especially now. That money could really be put to work for you in the coming months and years as we dip in and out of a recession and we see an increase in the gains that we're going to see in the next couple of years. The next item on our year-end financial checklist is open enrollment. So it's time to plan for your anticipated medical needs for the coming year. Are you planning on having a kid coming up soon? Do you have any anticipated major surgeries that could impact your coverage and your decision on which health plan you're using, whether or not it's a high or low deductible? So do your homework on the advantages of HSAs, dependent care, and FSAs. And check all our videos as we really unpack some of those specific types of accounts and some of the benefits that you could receive that you may not have thought of. For example, if you're looking at a health savings account, an HSA, you're going to have a high deductible health plan. Now, a deductible is the amount of money that you're paying before the insurance coverage fully kicks in and is taking care of most of that medical bill. So if you have a high deductible, it's going to be high cost on the front end. But long term, if you expect to have a lot of medical expenses, then it could be beneficial, especially if you are using a health savings account to save money for your long-term future medical expenses. And when I say long-term, I mean this is a very advantageous account to put money into because it's a tax triple threat, and we love things like that around here. So when I talk about health savings accounts, vast majority of people are going to use it and they're going to benefit from it directly. I think it's one of the best options for most people out there. The money that goes into it out of your paycheck is tax-free. So let's say hypothetically, just for simplicity, you have a 20% effective tax rate and you put $100 into your HSA. Well, that's $100 going directly into an account that you can use for medical expenses before it ever got taxed. So instead of you having $80 after taxes to go and buy a prescription or go to the doctor with, you now have $100 to be able to go and pay a doctor's bill with. Now, in a health savings account, when I say long-term benefit, that's because you can invest that money and it can grow tax-free. So that tax-free growth, when you go and invest that money and you buy and sell, let's say stocks, mutual funds, index funds is what I would recommend, then that growth is going to be tax-free. You're not going to pay capital gains when you sell those assets and then go use them for medical expenses down the road. And let's be all honest, the older we get, the higher our medical expenses get. And so this is something where you need to be thinking long-term about what kind of medical implications you may have on down in the line. You would much rather have money that's been growing and accumulating in an account that you're able to tap into later for all kinds of medical expenses for you and for your dependents, for your loved ones, for your family. And then the third item is that when you take money out and use it for medical expenses, it's not taxed as you take it out of that account. And so this is how it's a tax triple threat. Money going in, coming out, and growing within the account is all going to be tax-free as long as you're using it for qualified medical expenses, which is an extensive list. We're talking about everything from Band-Aids to vitamins to obviously doctor bills and personal hygiene products for men and women. And so this is something where an HSA, just check our video that I'll go ahead and link right up here, and you can check that link for an in-depth discussion of an HSA and why it's a benefit for you. Now, the next item on the open enrollment that I want to unpack is dependent care, because it's something that we directly benefit. Now, I've got a 6-month-old and I got a 2.5-year-old child, and both of them are in daycare. And for all of you out there, because I know I have a lot of viewers, we focus a lot on families here, especially families with young kids, and those dependent care accounts that you're able to put money into before it gets taxed is something that's going to be a huge, it's going to give you a huge edge when you're paying all those high daycare bills that you have. So if you've got kids and you're able to take money from your employee paychecks, and your employer is going to put it into a dependent care account up to $5,000 this year for married couples. I think it's going up a little bit next year. What you're going to do is you're going to take money from your paycheck before it gets taxed, put it into this dependent care account, and you're going to pay for daycare directly from that account. Again, simple math. We're talking about 20% tax just to make things easy. And if you take $100, put in the dependent care account, it's like getting a 20% discount on your daycare expenses, because otherwise you're taking post-tax dollars and putting them towards daycare. Now, I know a lot of you are thinking is that $5,000, that's not even going to cover one of my kids. And that's true for me too. We're talking about definitely multiple 5 figures of daycare. We're talking about probably to cost around $10,000 to $12,000 a year for our kids to go to daycare. And for a lot of you out there, it's even higher than that. And so this is not going to be a solution for all of your daycare expense, but it's going to give you a 20% discount on $5,000 worth of daycare expense. So why wouldn't you take advantage of that? Now, be careful because you have to use this money. The rollover is pretty small. I think it's only like $750 right now from one year to the next. So basically you need to plan out and do the math and plan out how much you're going to need for daycare and how much you can use by year end. That's why this is on the year end checklist, because this is a January 1st to December 21st kind of, December 31st kind of thing. So that's your second thing. First thing is an HSA, second thing is dependent care. The third thing is a flexible spending account. Now, if you're not using a health savings account, maybe you're planning to have a baby next year and you want a lower deductible, then consider using a flexible spending account for some of those specific medical costs that are going to come along with having something like that. So the downside to a flexible spending account is it's like a dependent care account where if you don't use it, you lose it. So you need to go ahead and do the math and really plot out your plan. So that's really one of the only situations that I could see if you, for some reason, really need to lower that deductible and not have a high deductible health plan for the upcoming year, then a flexible spending account can be a good consideration for you doing the math. Now, with all of these with open enrollment, I think that it's very beneficial to have an unbiased person step in, not necessarily someone in HR from your employer, not necessarily always someone from the insurance company or on the medical field itself, but if you can have an advisor, a tax pro, or a financial coach step into the ring with you and really help you double check that math and make sure that you're going to be getting the most bang for your buck. This time of year is a time to lower the inefficiency as much as possible, and it always starts with your paycheck. You want to have an optimal paycheck week after week, month after month for the coming year, so that when you get to year end next year, you're seeing yourself farther ahead than you thought you'd be in your financial goals. Go ahead and hit that subscribe button, hit the thumbs up, follow us on all of our social media so that you can get our daily and weekly content that's going to help you achieve your financial goals. Your next item on your year-end financial checklist for this year is going to be to focus on insurance. That's going to be life insurance, checking on your home and auto level of coverage, and consider an umbrella policy depending on your level of risk. Now, when I think of term life insurance, I'm focused on that term, T-E-R-M, not whole life, because there's a lot of scams out there, a lot of people on TikTok and Instagram and Facebook and Twitter trying to sell you whole life policies and pretending like it's going to be a money machine, a bank, some sort of life-changing way that you're going to be able to print your financial future. And let me tell you, that's not how insurance policies work. It's going to be inefficient. And in the long run, it's going to take you 2 steps back when it comes to where you want to achieve your financial goals. And so when you're thinking about insurance policies, they need to serve the purpose of an insurance policy. Term life insurance is going to be by and far more efficient, and you're going to have more money in the long run when you get to that 20 or 30 year mark, depending on what term you are. And when I talk about term life insurance, I mean you're going to have life insurance. You can have a specific payout amount. So for us, we use 10 times my annual income is going to be our whole policy, term life insurance. So if anything happens to me, my family's taken care of, and that lasts for us for 20 years. We have a 20-year term on our life insurance policy. And it's, again, 10 times my income. We have the same thing for my wife. Even if you're a stay-at-home parent and you don't have an income, you need to be considering the cost of taking care. It's really just child care, daycare, if anything happened to your spouse. And so regardless of what your occupation is, there needs to be I recommend at least $250,000 term life insurance policy on each spouse, and then it can increase from there depending on what your income and your lifestyle is. So that's the first item that everyone needs to have, especially if you have kids. Do yourself a favor. Don't put your family in a situation where they take 2 steps back and they're left in a lurch because you did not have something to protect them in your absence. Now, the second thing would be checking on your home and auto level of coverage. And this is important because, I don't know if you noticed, but the real estate market hasn't crashed like everyone was expecting. I heard a lot of people try to polish off their crystal ball and think, oh, we're going to see housing prices crash 30%. Well, they haven't. Your house is worth more than it was last year, and it was worth more than the year before that, and that, and that. And so the trend is continuing on. But what's important for you when it comes to insurance is making sure that your insurance policy is going to be able to help you replace your home if something happens. And so if you're in a situation where you can handle financially some catastrophic loss and only get a partial payout, that's up to you. But for me, I recommend making sure that if your house burned down, that you're going to be able to replace it and as good or better quality than what you have today. And so really, doing the math, sharpen that pencil, and get an assessment for what your home and auto level of coverage is, so that you're not in a situation where, like our Q&A later today, where your car gets stolen and then now you're not only just without a car, but your insurance wasn't enough to cover a replacement that was as good or better value. Used car prices are up, new car prices are up, home prices are up, and so make sure that you're covered in case the worst happens for the upcoming year. And the third item in the insurance world to consider is consider an umbrella policy depending on your level of risk. So in our situation, we have, we're landlords, and so we have rental property and we have individuals living there. And if we were in a situation where we were going to get into some sort of liability risk, then our umbrella policy is going to cover that. And so I recommend, especially if you are a business owner or you own rental property, you have some sort of extenuating circumstance of risk. If you have a teenager driving a car, if you got a teenager behind the wheel, then an umbrella policy is going to be a great way to reduce your liability risk when it comes to some of those unforeseen circumstances. So I recommend, it's like a couple $100 to get $1 million umbrella insurance policy for year over year. It's just like a couple $100 a year, and it's going to give you a lot of peace of mind, and it's going to protect you in the worst case scenario. Your last item on your year-end financial checklist is my favorite: goals. You need to know where you are, you got to know where you're going, and this is going to provide you momentum and is going to reveal inefficiencies so that you make the most of your financial future next year. When I say know where you are, I mean looking at a net worth calculator. This is time to check the pulse. It's like getting a physical at the doctor, which you should also be doing every year. You should go and check out a net worth calculator and get an assessment of where you stand. I know it's been a tough year. No one wants to open up the hood and look at their broker portfolio and say, wow, look at all the money we've lost. I mean, the S&P 500 is down 17.5% year to date. It's going to be painful to look at. But the reality is that you got to know where you are to be able to chart a course and know where you're going. And when we talk about SMART goals, they got to be measurable, they got to be simple, they got to be attainable, they got to be relevant, they got to be time bound. And we create tons of content when it comes to unpacking specific goals. When we work with our coaching clients, it's where we start and it's where we end. What are your financial goals, and how are we charting a path to get there with high inefficiency and revealing some of those inefficiencies so that we can really take those and turn them into strengths. So when you have SMART goals that you have charting your course of where you're going, you know your starting point with your net worth calculator, it's going to be encouraging, it's going to provide momentum, and it's going to reveal those inefficiencies in your plan, especially when you're working with a tax pro, a wealth advisor, and a money coach, to tie it all together and to help you make sure that the math is working in your favor. Because everyone out there, I don't care who you are, you can be the most savvy financial professional on the planet. There's at least going to be 1% inefficiency in the dollars that you attain and the dollars that you spend. Whether you're investing or spending, there's always going to be inefficiencies there somewhere. 1% could be a massive difference between where you are and where you want to be, not just 12 months from now, but 3 to 5 years. That 1% is going to grow in its impact of where you end up years down the road. Now it's just 1%. Consider if you had a 5% inefficiency, or what if you sit down with someone and they say, wow, 10% of your budget, of your cash flow, of your investments is inefficient. Well, that's going to be something where if you have $100,000 invested and it's compounding over the course of 10 years, that a 10% inefficiency could be the difference of your entire principal in that investment. So it could be plus or minus $100,000 10 years from now. And so if you think about in those terms, this is, the payoff is so high to make sure that your financial plan is fine-tuned and you know where you're going and you know where you stand right now. So I consider this to be a great opportunity for everyone to schedule a coaching call for the fourth quarter of this year and entering into the new year, it's not just about resolutions. This is about long-term goals and long-term life-changing actions that are really going to impact you 3, 5, 10 years down the road.